On All About Stocks this week, the Nifty is down to a two-week low. On weak earnings, we'll tell you if this is a buying opportunity. RIL Q4 meets estimates. What should you do with your RIL holding? And our investment advisor, G. Chokalingam, tells you why you should invest in JK Tyres for the long term. Welcome to All About Stocks. Thank you so much for tuning in. This is a show that's meant for you as a retail investor to catch up on the markets at the end of the week. While you've been busy all week, we've been tracking the markets for you. We're going to tell you over the next half hour what stocks and sectors you should be focusing on for the long term. Now, we've begun another earnings season, and as expected, the numbers are going to be mixed, to say the very least. There will be some disappointments as well. And on this show, we'll tell you which of those stocks you should be holding on to and which ones you should be selling. Remember, there's an email ID at the bottom of your screen, and you can reach me on Twitter whenever you need to. First, let me bring in my colleague Ajay to give us an update on all of the action on the last street. Ajay, also take us through those very important and very impressive RIL earnings.
Well, Faye, another week of profit-taking for Indian equities, but we are not alone. This particular week has been particularly rough for global markets in general and emerging markets. So we also saw some profit-taking. Most of the traders also say that, last week we were almost staring at 8,800. So we had rebound pretty sharply from the lows made 2-3 weeks back. So we are already trading at upper end of the trading range, and hence some profit-taking started coming in. In fact, lack of fresh triggers and concerns regarding the fourth quarter earnings season is also something which is encouraging people to take profits wherever they are. Also, traders believe that there are high probability that in the next couple of weeks, if earnings continue to remain extremely weak and global cues continue to remain rough, we may actually test the 200-day moving average once again, which lies around the 8250 mark as far as Nifty goes. But at those levels, there is a lot of long-term money which is sitting on the sideline, would take this opportunity to start deploying funds, and that's how even retail investors should approach the market right now. The couple of companies have already started declaring the numbers. Reliance was good. TCS is all on the weaker side. IndusInd Bank and DCB on the private sector banks were actually good. So up till now, the earnings season is pretty mixed. Not very bad commentary coming in, but most of the traders on the street say that direction in the market near term would depend not only on the performance for fourth quarter, but also commentary of how the coming quarters are likely to be, because fourth quarter weakness is largely in the price. Look at how there was a broad-based kind of a weakness witnessed in this particular week. Financials came down, power sector, healthcare and IT was punished pretty sharply because of lower growth prospects and very high valuations. Even mid-caps have started correcting. So there's a kind of a correction which is going on right now, but traders believe that it may be very choppy here. We may actually go down, but long-term investors should look at quality stocks where earnings are good, management commentary is very positive, and the stock is being punished because the overall market is going down, so that long-term portfolio can be made in these type of big gashes.
All right, Ajay, thank you for that update. Joining us today, G. Chokalingam, founder of Economics Research. Choka, thank you for coming in. It's always a pleasure to have you, especially on an interesting week like this. TCS numbers disappointed, RILs did not. They came out on Friday. The margins were much better than the markets expected. Tell us what this means for those of us who are holding the RIL stock.
Definitely they should hold on, and those who do not hold it, and in case there is any correction, even otherwise one can start accumulating, because last 4 to 5 years it has been underperforming the market, and I think time has come for the stock to perform. Not only the results, last week they commissioned the petchem and resin business capacities. They expanded in a very big way, and if you look at the latest numbers, they expanded the fixed assets by 85,000 crore. Whereas the debt has gone up only by about 14,000-15,000 crore. So a lot of internal money is used to expand the assets in a very big way. I'm sure going forward it will pay off.
No, so when you say the stock will begin to perform now, from where it is at this level, where do you think it can go? What sort of values are you looking at on the stock?
See, it is only question of perception. Because see, right now it is trading at 11-12 PE. And last 5 years, since the growth was not there, the PE got shrunk. Otherwise, in the distant past, it used to be a great wealth creator. So it failed miserably because the core business was not making big money, and the PE got shrunk. Now, at around the same 12-13 PE, the stock may go to say 1100. But if market starts perceiving in a positive way, and there is a PE expansion, which I believe likely to happen in the next 12 months, then the stock can go to even 13-1400.
Let's also talk about the TCS numbers. Now, the TCS's Q4 dollar revenues missed expectations. There was also a one-time bonus payment that hit the bottom line as well. Tell us about TCS. Do you think that perhaps, it's unfair for us to expect those, those kind of numbers from the IT industry that we used to expect some time ago?
Certainly, yes. It is very unfair to expect that kind of performance because, the base has grown much bigger. In early 90s, the India's IT exports were hardly in less than 10,000 crore. Today, you have as much as $85 billion. So the base has got expanded. And this base has expanded at a time, the developed world is not growing in a big way. The entire Eurozone is expected to grow at 1%. US also now growing at around 2.4%. So it is very difficult to expect that kind of growth. So, and particularly for TCS, it's already leader in terms of the PE valuation it enjoys as compared to other companies. So therefore, this has come at a wrong time. And so therefore, I would suggest one has to sit on IT stocks because there are a lot of uncertainty. Immediately, you have the monsoon forecast by IMD. Already the US agency forecast that, it could be pretty bad for India. And second, then the reversal of interest rate in US. So this can have impact on the currency. And therefore, it is better to hold on to IT stocks. But I would prefer a stock like Wipro rather than TCS.
All right, Wipro instead of TCS. What about among the slightly mid-cap or the smaller companies in the IT sector? What would you hold on to as insurance for, say, a bad currency market?
We covered several times, something like Polaris and Sasken, but unfortunately, they also ran off in the last 10-15 days. Though the large cap stocks were beaten down, these stocks have improved actually anywhere from 10-20%. So if there is any small correction also, one should hold on to, buy these kind of mid-cap stocks.
It's an interesting piece of advice, though, that even if we continue to see bad numbers from the IT companies in this, in this earnings season, don't, get rid of your IT stocks because a bad, particularly bad currency market will mean that IT stock is insurance for you. I want to ask you about the banking sector. Now, we know that the banking sector got a rate cut from the RBI in this quarter that it didn't exactly pass on as quickly to its customers. What do you expect that will have an impact on in terms of numbers for the quarter and in terms of asset quality and things like that? What are you expecting from the banking sector?
Yes, there will be slight impact on the the margin because they are passing on the interest rate. But see, historically, if you see the banking sector always they come back to the normal growth. So this is not going to impact them very badly, and and definitely the RBI has to follow with the rate cut. So this would be compensated before June itself. I am expecting the rate cut. Fourth month in a row we have seen negative inflation. Across the world, the worry is not on inflation, it's worry is on deflationary trend. So we are the only one, as I've been saying again and again, sitting in the island of inflation worry. Yes. So that will go away, and look at even the oil, petrol, diesel price are cut. So that also will pull down. So unless monsoon fails miserably, you are going to see the deflationary pressure continuing for both the WP and CPI.
And that's good for all banking stocks, private and public? Or
still my take is on private. I mean, and at least another 3 to 6 months, one should stay away from the PSU banks.
All right, stay away from PSU banks, of course. Let's also take a look at Choka's portfolio. We had asked him to design a portfolio for us, and this is a very interesting portfolio. In fact, among most of our viewers, it's the most popular. Now, he designed this portfolio on the 8th of August 2013. It's at an overall gain of 105%. Now, look at this. The Nifty over the same period is up 54%. So, you outperformed the Nifty by double. This is a list of the stocks in this portfolio. There's JCB Chemicals, Polaris Consulting, South Indian Bank, International Paper Corp, Navigli Lignite, Bombay Burma, it's up 120%. Emphasis, Karur Vaishya Bank, Bama Lorry, Moil, Biocon, KCP Sugar, and Claris Life Sciences. I'm given to understand that you want to make a couple of changes in your portfolio. What would that be? Yeah,
just I wanted to replace International Paper with the Genus Power. My relative conviction in Genus Power is much stronger. And paper prices are weak and import is happening, and this stock also highly volatile. Unfortunately, after we recommended it went up to 390, then came down to 210,
Something
220.
Happening behind the screen that we can't really see.
Unable to understand. Okay. So I don't want the retail investors to suffer. Now again from the bottom it has moved up by 40%. So I want to use this opportunity to tactically replace it because it's anyhow it's a very long-term call. Yeah. Short term I don't expect the company to post a decent profit growth. In terms of PE valuation it is already very costly.
Why Genus Power?
I like this stock very much for its fundamentals. It is a leader in the electricity meters. They make electricity meters for all sort of consumers, from the household to large infrastructure projects. And the budget has proposed to hike the infra outlay by 30%. There's a lot of investment plans are there from both central and state government. And also the government has proposed housing for all by 2022, which means every new building will require one electricity meter. And therefore, the market for the electricity meter will expand. And being in a power component business, this company has got a strong balance sheet, which is very rare in the power or power component business. The long-term debt is only 3% of the total debt. And in December quarter also, they have done very well. Sales have grown by 19%, profit has grown by 31%. And lastly, the company has cleaned the balance sheet. They have been doing a lot of write-off and strengthening the balance sheet over the last 2 years.
In fact, when I look at your portfolio, Neyveli Lignite is down 24% since we bought it. That doesn't cause you concern? You don't want to make a switch out there, or you think it makes sense to hold?
Very interesting question. Sometimes market is unfair even in the medium to long term. You won't believe the same Neyveli Lignite in 2000 or so. I bought at 14 rupee, it became 6 rupee 25 paisa. From 6 rupees to 12 rupees, stayed there for 3 years. After that, it went to 250. But valuation is very appealing. It is available at one-time book value. Let me tell you, this is the only power producer which has got the fuel at the power station itself. Entire lignite, which will last for more than 2 decades. And this is the only power company which has got a net cash. Few thousands of crores of net cash.
So that much affection to the stock, do you want to add some more to the portfolio?
Certainly, definitely one can average and add, And also good dividend yield they pay. And recently they got approval to, commission 1,000 megawatt of power project in Tamil Nadu. So it's a beautiful stock, to hold for medium to long term.
All right, so that's a beautiful stock that we're going to continue holding on to. I'm going to give you a recap of Choka's portfolio. JCB Chemicals, Polaris Consulting, South Indian Bank, Genus Power, Neyveli Lignite, Bombay Burma, Emphasis, Karur Vaishya Bank, Barma Lorry, Moil, Biocon, KCP Sugar and Claris Life Sciences. Remember, if you have any questions about this portfolio for Choka or any other stock that you're holding on to, feel free to write to us. Our email ID will be at the bottom of this screen and you can reach me on Twitter as well. Welcome back. You're watching All About Stocks on ET now. Thank you for staying with us. G. Chokalingam is with us, helping us figure out our long-term strategy for our portfolios. He's been doing this for years, so we're so glad to have him back in the studio. Now, we'd asked Choka to pick one stock that he believes at current valuations you and I can buy on Monday morning and add to our portfolios. The stock he's been kind enough to pick for us is JK Tyre. Now, JK Tyre is on your screen right now. You'll see it ended the week at about 124. And it's very interesting that you're bringing it into focus right now. Of all the tyre stocks available, why JK Tyre?
Yeah, in fact, we had this in August 2013.
Yes, in New York City.
It made more than 200% profit and I came out. But unfortunately, after we exited, again, it went up substantially. But from the peak, it has corrected 21%. And compared to other tyre stocks, it is still trading at, little less than 8 times 1 year forward earning.
Okay.
And so this is why, I picked up this particular tyre stock. And very interestingly, this has got 3 plants in Mexico. They acquired the Mexican plants for about 270 crore. In the last 21 months itself, they made about 311 crore segment profit from Mexican plants. So the opportunity for making a lot more money from Mexican plants very high for this stock. And other points which are general to all the tire companies is that, the tire price, natural rubber price again tanked. Year on year basis, they are down by 19%. In fact, just before the budget, the rubber prices went up substantially. That was another reason to exit in the past.
Yes.
Now, again, they have cracked by more than 10% rubber prices. And again, oil price also remained at around $62, $63. So all these are positive. Finally, now 1.5 years has passed, from the time of we including this stock in the portfolio. Now, when you introduce FY17 number, again, it makes a very attractive investment proposition. I am expecting around 21 rupee EPS for FY17, 1 year forward. That's again very conservative. It can even outperform that by big margin. So therefore, I believe that this stock can once again perform very well.
Well, we talked about how it's at 124, I think, at the end of this week. So buy at these levels entirely, or do you think we should stagger, wait for more corrections and pick up at more corrections?
Don't buy any mid-cap stock in one go.
Right.
Forget the fundas. The volatility is so huge. We have seen it. So therefore, I suggest that all the retail investors should stagger it in 2 or 3 phases. They should never buy in a single go.
All right, never buy any mid-cap stock in a single go, especially in a market like this one with the kind of volatility that we're seeing. We have a question from Vinod. He's written in. He has 100 shares of MCX, which he bought at 1,300 rupees. He wants to know if he should hold on to that stock. MCX will pop up on your screen in a little while. You'll notice that it ended the week at around 11.19. What should he do with MCX?
I would sell. In fact, we discussed on the same program MCX long ago at around 700, 800. It has already become a multi-bagger. So I would always suggest in mid-cap investors, chase the stock which can become multi-bagger rather than the stock which have already become multi-bagger. And also, if you look at the fundas, the COMEX turnover, the commodity exchange turnover for FY15 is down by almost 41%. So there are no signs of the exchange business increasing substantially. So therefore, based on the valuation comfort, I would say sell and buy JK Tyre.
All right, let's take another question. Sham has written in, he has 1,000 shares of UCO Bank, which he bought at 64 rupees. He wants to know if he should hold on to that stock. Now, UCO Bank ended the week at about 68. It might not be the smartest banking, button in the box, really. I'm sure that you have Karur Vysya Bank in your portfolio, you have South Indian Bank in your portfolio. Would that make better fits for him?
Certainly, because net NPA, gross NPA 5 to 6%, and it's a simple benchmark to compare is that you compare the outstanding net NPA with quarterly net profit or annual net profit. So this bank in that ranking will be at the bottom. So therefore, I would say sell and buy Karur Vysya, or if somebody wants something in large cap, one can go for Axis Bank rather than sitting on this POC bank.
Rama Iyer has written in, 90 shares of Tata Power bought at 86 rupees and 90 shares of Finolex Industries bought at 286. Should I hold on or should I sell? Tata Power, let's talk about that one first. It ended the week at about 80 rupees and 45 paise. Hold on to Tata Power? I mean, I know you have other power stocks that you prefer because we talked about that on the show, but what about Tata Power?
No, last 4 or 5 years I have been avoiding highly leveraged companies because there has been a lot of failures in the stock market purely because of leveraging. So though it's a part of a reputed group, I would still suggest sell Tata Power and buy Axis Bank. So Finolex industry one can sell now and buy Janus Power because US agency has already forecast that the monsoon will be pretty bad in India. And now we are awaiting anxiously the forecast by the IMD, Indian Meteorological Department. By any chance, IMD also gives a very pessimistic forecast on monsoon, then these stocks will take a beating because it makes pipes for the agriculture sector.
Okay, all right, so exit that stock as well. Let's take another question. Nuthan has written in, she has 100 shares of Strides Acro Labs at 881 rupees. She wants to know if she should hold on to that stock. This stock has been such a phenomenal performer over a slightly longer term view if you take a long view on it. What would you recommend she does with the stock now?
She can hold on. I mean, in entire pharma space, I am still optimistic. And this has been doing very well, so she should hold on to it.
Hold on to that stock. One last question before we take a break. Abhishek Sharma has written in 500 shares of SAIL at 78 rupees and 200 shares of Power Grid at 156 rupees. Should he hold on to both of those stocks? I mean, again, we're coming back to the whole, sector of commodities of steel. Would you recommend he holds on to SAIL?
I would stay away from steel industry. It's very unfortunate. I have not seen this kind of trouble for the industry. 71% increase in the import in the last financial year. Globally, steel prices are down by 26% in the last 6 months. Even in India, the realization is down by 6%. So it's a really pathetic condition, the state of steel industry. So I would avoid such a sector and move on to safe growing sector. And like therefore, I suggest Axis Bank.
Okay.
Power Grid one can hold. There's a lot of potential for growth.
All right, so hold on to Power Grid, exit SAIL, buy Axis Bank instead. Welcome back to watching All About Stocks in ET now. Thank you for staying with us. G. Chokalingam is with us as well. It's time for us to look at the portfolio of our one lucky viewer. And Zanghar Shah is our viewer this week, and we're going to take a look at his portfolio, tell him which ones of these shares he should be holding on to. To start off with, he has 20 shares of Blue Star, which he bought at 298 rupees on an average. He wanted to know if he should hold on to that stock. Now, Blue Star rounded, ended the week at about 333. Is Blue Star a good option at this point?
The stock has run up a lot, and if you see in the last 5 years, cumulatively, the sales growth has been only 12% cumulatively. Even for 9 months, it's not a great growth stock.
Yes.
So I would suggest shift to JK Tyre, which I consider as a solid growth stock at this juncture.
All right, let's take another one. He has 30 shares of SBI, which he bought at 370. Now, SBI is about 290 at this point. I know that you're not too soft right now on, public sector banks. Would you recommend he exit SBI as well?
Certainly. I would still suggest exit even a bank like SBI and move to Axis Bank.
But there's an argument that SBI being such a large bank, and if we are going to bank the unbanked in this country, that SBI will be at the forefront of it. There'll be a lot of mergers with the smaller banks as well. You don't see any value coming out of that for a long-term investment?
Certainly you are right. It's a leader and it will create wealth. But if you see whether the last 5 years or 10 years, 20 years, 15 years, ever since these new sector banks have come in, ICICI Bank, the kind of wealth they create is phenomenal. 10 rupees share of Axis Bank used to be 40 rupees. So there is no looking back. All these, including Yes Bank, ICICI, they have been phenomenally growing the wealth for the investors. So that kind of wealth was not created by any PSU sector bank in this country.
All right, so that makes a pretty strong argument there. 10 shares of Abana Offshore, which he bought at 430 rupees. He wants to know if he should hold on to Abana Offshore. What would you recommend? Does it make sense at this point?
See, in terms of PE valuation, when I look at it, it is trading at 5.6. But the kind of a debt close to 13,000 crore, and also after oil price crash, there is always a lag time in adjusting to the rig prices. So most of its rigs are coming for renewal in this current calendar year. Okay. So I doubt whether they would be able to good rates for them. So therefore, I would suggest sell and buy Lupin, which has cracked in a big way on Friday by almost 7 to 8%. So one can use that opportunity to shift.
All right. Okay. He also has 20 shares of Amtech Auto, which he bought at 170 rupees. He wants to know if he should hold on to that stock. What would you recommend?
Actually, I'm not that comfortable because debt and sales are almost equivalent to 15,000 crore. For auto component company, you know, debt is being 15,000 crore for a turnover of 15,000 crore. But still, stock has corrected a lot from 270 level to 170. So one can hold on for some time.
Okay, and last stock on his list, he has 300 shares of First Source Solutions, which he bought at 300 rupees. I'm going to pull up that stock on your list right now. It's at about 32 rupees there. What should he do with that?
I mean, it is very surprising to see that he has 30% allocation to First Source Solution in his whole portfolio. I mean, if it is a real portfolio, it is very dangerous to have a one small cap stock 30%, because small caps are known for high risk. So he can hold it, but he should cut down the exposure to 10% and add stocks like ITC and Hindustan Zinc, you know, different sectors, so that the whole portfolio gets some stability.
No, when you say hold on to it, what sort of expectation do you have? What will be a trigger for a stock like this one?
See, the trigger is that the valuation multiple should improve for all the mid cap IT stock, which is already happening. Like if you look at Exavar, it used to trade at 76, now above 300. Even Polaris went down to 90, or even few months back 135, it has run up. So in the last 10 days also, when large cap stocks have got beaten down, the small cap IT stocks are quite firm. My sense is that, you know, in the next 12 months to 18 months or so, there could be one or two more consolidation, because as we discussed earlier, the large IT cap stocks are not able to grow in double digit.
So give him a target. If he's at 32 right now with this stock,
he should get at least a 15-20% return.
Okay. And then he should exit it.
Yeah.
He should not. Okay. All right. So that's the recommendation there. What is your disclaimer on the stocks that we talked about?
The old portfolio, I have Karur Vysya Bank, South Indian Bank, KCP Sugar, Balmallari and Moil. In the recent time, I have not done any of these transaction in the last couple of months.
All right, so that's the disclaimer. Choka, thank you so much for spending time with us this week and answering all of our questions. If you have a question for Choka, feel free to write to us. Our email ID is at the bottom of your screen. You can reach me personally on Twitter as well. Thank you so much for watching.